Starting off with the hedge fund manager themselves, I think it is interesting to note that despite the fact that hedge funds only became regulated in 2015-2016, the hedge fund managers have been financial service providers for decades and have always been regulated by the FSCA and before that by the FSB. Therefore, hedge fund managers have been accountable institutions in of themselves, even in a pre-regulatory regime where we had these regulated structures for the hedge funds underlying these managers. To become licensed as a hedge fund manager with the FSCA is quite a difficult process, and the requirements for holding that license, a so-called 2A, is more stringent than essentially any other FSP license. Among other things, the experience and capital requirements are far more onerous than for any traditional fund manager or advisor financial services provider. In 2015, hedge funds moved from the obscure, unregulated space into the unit trust space, when the Minister of Finance promulgated the amendment to the Collective Investment Schemes Act and essentially deemed hedge funds, which were private equity type structures at the time, to be collective investment schemes. The regime created two types of hedge funds: a qualified investor hedge fund, catering to the existing institutional investor type funds that already existed, and a retail investor hedge fund, catering to the end investor, more akin to the traditional unit trust and remarkably similar in structure. Proposed amendments to CISCA will allow balanced fund of funds to also allocate 10% of their overall holdings to hedge funds. In the current regulatory regime, all fund of funds are not technically allowed to invest into hedge funds because of some outdated conflicts between different pieces of legislation. There is, however, draft legislation sitting with the National Treasury to amend the CISCA Act to allow fund of funds to invest into hedge funds as they are allowed to do in terms of Reg 28. The regulator deems hedge funds to be a specialist investment and have a specialist category that has to be present on your advisor's license in order for that advisor to allow you to invest into hedge funds. Quality advisors should have this category present on their license, or at the very least have a plan in the pipeline for getting the necessary supervision to add this category to their license in order to open up the world of hedge funds to their clients. When hedge funds became regulated in 2015, two legal structures were set up to accommodate the two different types of funds that were available. Qualified investor hedge funds for institutions, high net worth individuals, the historical, higher risk, higher concentration, less transparency, traditional type of hedge fund, and the retail investor hedge fund, more designed to be clean, transparent, very liquid product available to the retail investor. A qualified investor hedge fund has a minimum investment threshold of R1 million and requires the demonstration of a certain level of investment competence from the underlying investor. A retail investor hedge fund, similar to a traditional unit trust, has a minimum investment of around R1,000 with a monthly debit order and a notional limit for a once-off cash investment. A qualified investor hedge fund can take significant concentration, invest in a wider range of less liquid securities, whereas a retail investor hedge fund is much more tightly regulated in terms of the liquidity on the underlying investments and the amount of concentration it can take. Retail investor hedge funds are the only hedge funds that are available via the investment platforms because, again, they can potentially price on a daily basis, similar to the traditional funds, and offer that liquidity and security to investors. Qualified funds, on the other hand, typically have a 3-month notice period for both subscriptions and redemptions, and are far less liquid and are potentially less tax efficient as well.